Hi stock investors, JJ here. Welcome back. Well, today I'm going to react to Jeremy Siegel, Professor Jeremy Siegel from Wharton, and he is saying we are in a slowing economy. He sees data here and he's got some implications for that, or some suggestions that the Fed should do. As you know, talking about rates, let's get straight into what Jeremy Siegel is saying today.
Thank you. What is your take after this jobs report and the market's reaction to it?
Yeah. You know, I think it was a pretty weak report. When you look at the details.
So the jobs report came out and unemployment rate is rising.
The headline number beat, the revision was beat, the details were not good. We are in a slowing economy. The Fed at the beginning of the year, last December, said that GDP growth this year was going to exceed 2%. Well, we got first quarter, that's under 2%, and although we're all enthusiastic thinking, oh, this quarter looked like 3, then it looked like 2. Now most of the experts, including Atlanta Fed and the other banks, think it's under 2. I think it's really time for Chairman Powell to really tee up in the July meeting a cut in September.
Okay, so he wants a cut. He wants the first rate cut to be in September, and they've been waiting. The Fed's been waiting there. There's been no reason to cut so far, even though the market at the beginning of the year said there'll be 6 rate cuts, or people were suggesting, predicting 6 rate cuts throughout the year. That hasn't happened. Now they're talking. We were talking maybe November, December, and Jeremy Siegel here is saying he's seeing signs of a slowing economy, and we have seen in those past earnings, just in the recent earnings, retail brands, retail companies have definitely seen slowing numbers, and we've seen some big write-downs or drawdowns of the stock price. We've seen Starbucks and Nike in particular. These retail brands, go and have a look if you want to see their stock prices have been plummeting, and others have been coming in weak. And so the Fed will be seeing that, not just the stock market, what the stocks have been doing, but the company results themselves. That's the important thing. It's a voting machine, the market, but a weighing machine in terms of the actual results. It'll be interesting to see Tesla numbers that'll come out in late July here. So Jeremy Siegel thinking there should be a rate cut soon, that they should tee it up. Did he say in July, and then actually do it in September? So rate cuts are coming in, so that, and of course the election coming up, so that changes things in terms of what people look at as well.
And maybe another one in November.
Okay.
I think inflation is definitely under control, and I don't want to see this slowing economy turn into something worse.
No, that's the risk, right? That, as you lay it out, that the job market.
He's talking about something worse being recession. They're slipping into recession, which, a lot of economists, many economists predicted the big one in 2023. It never happened, and it's sort of been this Goldilocks zone. But is it starting to happen now? The Fed's purpose of raising rates was to slow the economy, so bring inflation down, and everybody thought there would be a recession. It hasn't happened yet, but could it be on the horizon now even?
Market, half the mandate, right? Let's not forget, half the mandate about employment. The job market doesn't get away from the Fed just when they think they've got it right.
Yeah, absolutely. There's an economist, Claudia Sam, SAHM, who many years ago had a rule that she investigated, that when the unemployment rate rises a 0.5 percentage point, and that was on a 3-month moving average basis, the probability of a recession was well over 90%. Well, guess what? With today's report, we just moved to 0.5% over the low that we hit earlier this year. So I'm not saying there's a recession, and I don't think it's anywhere near 90%. I'm just saying that the Fed has to take some of these indicators, including the inverted yield curve, into account, including the slow growth of the money supply, which although...
So the inverted yield curve, remembering, if you don't know, that usually quite often there's a recession that happens after inverted yield curve. I think it's been 2 years since that. It's usually within 2 years. I think it's around 2 years since that first happened, and so that was an indicator. And that is a big reason, I think, why economists thought there would be a recession, which they've managed to hold off. And Jeremy Siegel's not saying there will be a recession here. He's saying that if the Fed doesn't act, there could be, because he sees slowing numbers.
Has stopped shrinking, is not growing fast enough to, I think, support a strong GDP economy. So although I think stocks are still in an uptrend, and the growth stocks still are certainly walloping the value stocks, I think Powell has to take note.
I feel like you're suggesting that no cut in September means recession on the table. No cut in September means this market might be in trouble.
Potentially, yes.
So, yeah, if they don't cut, he's saying, if they don't cut rates, he wants them to cut rates soon. That's the gist of this whole thing. He's calling for a rate cut sooner rather than later, September, which isn't that soon, but it's as soon as, in terms of how fast they move.
And again, I'm looking at the future. Listen, next week we get the CPI. That's certainly going to be very important. We have jobless claims. I like to see them under 240. They've just been tickling that 240 level, a breakout on that. Why not be preemptive? The commodity market is under control. All the others are under control. Being
preemptive, Fed Chair Powell said they want to wait. There's no reason to be preemptive like this. They want to see the numbers, and it's not instant though. If they change the rates, what's happening now is probably happening because of what they did. They've been raising rates, and that was quite a long time ago now. It takes quite a long time for these things to filter through.
Control, as you know, Scott, we've talked so long about the fact if they use realistic shelter costs in their CPI, they would be much lower than what they have now. I think he can afford to bring us a more normal Fed funds rate and relationship to those long rates, which do see, as we saw today, a potential slowdown.
Okay, so what do you think of that? Let me know in the comments. Do you agree with Professor Siegel here, the professor, that they should start to cut rates as early as September rather than later on in the year, based on what we're seeing now? And also, I'm going to put a link on the screen now to a video that YouTube thinks that you should watch next. So go and see that now if you want to. And also subscribe to the channel. We're relatively new here, posting regularly my reactions to these daily news of the stock market and economic events. So do subscribe if you want to. Thanks to everybody for watching, and I'll see you in the next one.